Okay, so you want to own a megaport. You've seen the satellite imagery. You've watched the massive cranes gliding over thousands of steel containers, and you know the math on global shipping. 90% of all traded goods move by sea. You've looked at the cargo volumes, the docking fees, the handling charges, and you've decided a megaport is the ultimate toll booth. You're not wrong to think that. Ports are one of the most relentlessly profitable real estate assets on Earth. There's just one problem. The port you think you're buying isn't exactly yours. There are roughly 4,000 ports in the world. The top 100 megaports handle the vast majority of global trade, generating hundreds of billions in revenue every year. And yet, the actual owners, the people who put up the capital, poured the concrete, and bought the cranes, keep far less of that than you'd expect. Because somewhere between the cargo ship and the port owner, there are 3 or 4 other hands in the pot. Shipping alliances, terminal operators, rail companies, customs agencies, each taking their cut before the owner sees a dollar. Here's the part that breaks people's brains. The Port Authority doesn't actually move the cargo. In fact, most port authorities don't own the cranes, the trucks, or the warehouses on their own land. They own the dirt and the water. They lease the land to terminal operators like DP World or Maersk, who bring in their own equipment, hire their own longshoremen, and run the actual operation. You pay billions for the real estate, and then you hand the keys to a logistics company in exchange for a lease on the ground. Let's talk about what that actually costs, and more importantly, what's left after everyone else gets paid. Say you want to build a new container terminal at a major US megaport. Deep water, 1,000 acres, state-of-the-art infrastructure. To build a facility that can handle the largest ships afloat from scratch, you're looking at somewhere between $2 billion and $4 billion. That number covers dredging the harbor, paving the container yards, buying the ship-to-shore cranes, which run about $15 million each, and the initial permitting fees, which can take a decade and cost tens of millions just to get started. But here's the thing, you can't just build it and wait for the ships. The moment your terminal opens, the clock starts ticking. Because the shipping alliances, the MSCs and Maersks of the world, immediately send you a list of demands. Call it a capability mandate. A mandatory list of upgrades you must complete to keep their business. Deeper draft requirements for newer, larger ships, shore power electrical systems so ships can plug in instead of burning diesel, new automated gate complexes. As of 2024, infrastructure upgrade costs have risen more than 30% above pre-pandemic levels. A terminal capability upgrade can run hundreds of millions of dollars, and it's not optional. If you refuse, the shipping lines bypass your port. A port without ships is just a very expensive parking lot. Let's say the upgrades are done. Your 1,000-acre terminal is open. Ships are docking, containers are moving, revenue is coming in. Here's what happens to that revenue. The terminal operator takes their cut first. Because remember, you just own the dirt. The operator who leased the land handles the actual cargo. They charge the shipping lines a stevedoring fee for loading and unloading. On a terminal doing $500 million in annual gross revenue, the operator keeps the lion's share. You, the landowner, get a cut of wharfage and dockage fees. Dockage is what the ship pays to physically park. Wharfage is what the cargo pays to cross your concrete. Combined, they might net you 8% to 12% of the terminal's gross revenue. Before you pay a single employee, before maintenance, before insurance, which at a megaport runs into the tens of millions, just for the right to say ships can park on your shoreline. Then there's the labor problem, because most port owners don't touch the longshoremen. The unions control the gates, the cranes, and the yard. the International Longshoremen's Association on the East Coast, and the LWU on the West Coast. Labor accounts for roughly 50% to 60% of a Terminal S operating costs. In 2024, port workers secured massive new contracts with immediate wage hikes and total bans on automation. So every time a ship is delayed, every time a crane operator goes on break, your efficiency drops and the operator eats the cost, which eventually pressures the lease rates they can afford to pay you. Beyond the labor issues is the inland connection problem. A port is useless if the cargo can't leave. In 2024, somewhere between 30% and 40% of port cargo moves by rail. The Class Y railroads, Union Pacific, BNSF, CSX, own the tracks leading out of your port. They charge what they want, when they want. If their network gets congested, your containers pile up. You get hit with dwell fees, chassis shortages, and angry shipping lines threatening to divert to a competing port down the coast. Meanwhile, the port itself is a machine that eats itself. A ship-to-shore crane needs constant, multi-million-dollar maintenance. The asphalt in the container yard takes a beating from 100,000-pound steel boxes rolling on terminal tractors all day. Potholes aren't an inconvenience. They're a logistical bottleneck that costs millions to patch. You are constantly pouring capital back into the dirt just to keep it from falling apart. Stack it all up. By the time labor, rail freight, insurance, security, environmental compliance, and terminal operator leases are accounted for, the average port owner S-net profit margin on their investment lands somewhere between 4% and 7%. Some premier landlord ports in Asia or Europe push 15%. Most don't. On that $2 billion terminal investment, you're looking at maybe $80 million to $140 million in annual net operating income. To earn back a $2 billion investment, that's a 15 to 25-year payback period. If nothing goes wrong, if a bridge doesn't get hit by a ship, if a supply chain doesn't collapse, and if the river doesn't dry up. Here's where the story gets genuinely interesting. While port owners are scraping together 4% to 7% margins and fighting with railroads over container dwell times, the shipping lines are operating on a completely different level. In 2024, Mediterranean Shipping Company, MSC, controlled roughly 20% of the global container fleet. Maersk controlled another 15%. Combined, the top 10 shipping alliances control over 80% of global container capacity. They don't own the ports, they own the ships, the containers, and the routing software. And for all of that, they dictate the terms to the port owners. If your port has a labor dispute or your cranes are too slow, the shipping lines simply reroute to a competing port 200 miles down the coast. They have the ultimate leverage. Consider the downside for the port owner. A bad quarter means the shipping line still pays dockage, but a recession means cancelled sailings. The concrete needs repaving. That's the port owner's problem. This is the logistics equivalent of the asset-light model, and it has made shipping lines some of the most efficiently profitable companies in the world. While the port owner earns 4% to 7% margins grinding through infrastructure maintenance, shipping lines post-operating margins that swing from 10% to over 40% in boom years. Despite these margins, people do make money in port infrastructure. Real money, just not usually the way you'd imagine. Meet the global terminal operator, not a specific person, but an archetype, because the world's most profitable port operations have been quietly dominated by a handful of state-backed and private giants: DP World in Dubai, PSA International in Singapore, Hutchison Ports in Hong Kong. Almost always, the pattern is the same. A local government builds the deep water port, pours the concrete, and dredges the channel. They realize they don't know how to run the logistics at a global scale. So they lease the terminal to one of these operators. The operator brings in their own cranes, their own software, their own management team. They vertically integrate the supply chain. They squeeze 15% to 20% margins out of the operation by optimizing crane moves per hour and automating gate checks. This is how you make money in ports, not by owning one terminal and hoping the shipping lines keep stopping by. By operating 50 terminals across 30 countries, spreading the geopolitical risk, and using scale to negotiate better terms with both the port owners and the shipping lines. The port industry rewards scale and leverage. One terminal is a high-stakes liability. A global network of terminals is an empire. So, let's close the loop. You invest $2 billion in a 1,000-acre megaport terminal. Your annual gross revenue from operator leases, dockage, and wharfage fees is around $50 to $60 million. After terminal operator cuts, labor coordination, rail access fees, insurance, security, environmental compliance, and the crushing debt service on the municipal bonds you use to finance it, you're looking at somewhere between 80 million and 140 million in free cash flow per year if things go perfectly, if the unions don't strike, if a bridge doesn't get taken out by a wayward vessel, if the Panama Canal doesn't dry up and reroute global traffic away from your coast. Within 10 to 12 years, the shipping alliances will send another capability mandate. The ships will inevitably be larger. They'll demand deeper drafts, wider turning basins, and fully electric crane fleets to meet their own corporate carbon goals. Budget another $300 to $500 million for that. It is a cycle that never ends. You are perpetually paying to keep your port attractive to companies that have zero loyalty to your concrete. Eventually, when you try to sell the port to the next institutional investor or sovereign wealth fund, they will look at the remaining infrastructure lifespan, the aging electrical grid, and the imminent dredging obligations, which suppresses what they're willing to pay. You are passing a capital-intensive liability to the next guy, who is pricing in the exact same trap you fell into. Meanwhile, the shipping alliance whose vessels you are parking every single week reported record freight revenues this year and is projecting another massive order of mega ships. Their stock is up. The pipeline of vessels has never been larger. Port maintenance, crane upgrades, channel dredging, all of it is someone else's problem. MSC doesn't own ports. Maersk doesn't own ports. They own the most valuable thing in the maritime freight business. The reason a factory in Shenzhen can guarantee a 30-day delivery to a warehouse in Ohio. The container on the ship, the routing algorithm, the alliance network. They own the movement and you own the parking lot. Pouring $2 billion into infrastructure and cranes locks you into an operational grind that shipping alliances simply bypass. They don't need the parking lot. They just collect the toll. People look at a megaport and see an unstoppable toll booth printing money from the ocean, but the toll booth requires billions in upkeep, and the cars can simply choose another road at any time. Shipping lines don't own the ports. They own the reason the port exists, and that, it turns out, is worth a great deal more than the terminal underneath it.